Hey everyone, welcome to the Two Idiots podcast. This is your host Ravi here, and my co-host Ruben on the other side.
Hello, everyone. Yeah.
Today we're going to do a quick DCF on Palantir Stock. So Ruben, get us started, please.
Yeah, sure. Yeah. So as we all know, the Palantir just reported their. Can you all see my screen?
Yeah.
Yeah. So Palantir just reported their the 2021, the financial year, also their Q4. So they actually reported decent growth in their revenue, from all aspects. So probably their net income missed their Wall Street estimates, but apart from that, it's actually a decent number. And then they also have a decent forecast for the upcoming year. And then they are expected to grow roughly at 30% for the next all the way till 2025.
Okay.
So these are all the numbers. So I think we'll put this thing in the description so you can have a look, or else go to their investor relationship and then you can actually find this one out. So we will actually do a discounted cash flow, and then I'm so excited to do this one because this stock has took a very big hit. It all-time high was 52 weeks high was at $30. Now it's at 52 weeks. Yeah, it's at $30, and now it's at
12.45.
Yeah, it's just too low. Yeah. So actually, Ravi, you can share your Excel sheet, and then we'll just plug in the numbers, and then we just see.
Yep.
What is the right valuation for this one? Yeah.
Yep. Let's go.
As per DCF.
Sure thing. Yeah. So, folks, here I have a fresh DCF template, and what we actually plugged the numbers before the call. So we'll just we'll just quickly walk you through them. We're trying to be as conservative as possible. We don't want to take the lofty estimates presented in the earnings report. So we're assuming that the growth rate for the first 5 years from here on will be 25%, and the growth rate for years 6 to 10 Ruben is 20%, and the discount rate we've taken is 50%. So we're expecting a 15% return from this stock. That's what it means. The terminal value. So I'm assuming that at the end of year 10, I can sell out of this business at 20 times the year 10 free cash flow. That's what I'll net for the business. And so let's get started. So the year 1 cash flow, which we already plugged in, this comes from the cash flow statement. So that's 4.4 billion basically.
Yes.
And per their last results, they have $2.2 billion of cash.
Yeah, cash or cash equivalents. Yeah.
Yeah. So those are the key inputs, and presented here is the free cash flow growth as well as the present value of those free cash flow numbers. So as we explained, we are growing these cash flow by 25% for the first 5 years. So we take this 0.4 billion and we grow that by 25% for the first 5 years, and then we grow it by 20% for the next 5 years. And end of year 10, we sell it for 20 times this number basically, netting us roughly 72 billion.
Yeah.
And basically, this is the present value of all these cash flows reduced to current day.
Yeah.
So once you do this and crunch the numbers, you get the present value as $25 billion for the business.
Yeah.
Now, the cash on hand, if you remember, we get it from up top here is 2.2 billion. The total debt they have, according to the last report we saw, is 0.26 billion. And so basically what you do is present value plus the cash on hand minus the debt payments nets you $27 billion of equity.
Yes.
Yep. And Ruben, you were just telling me that they have roughly 2 billion shares.
2 billion shares outstanding.
Yeah.
So that gives us roughly the value per share of $13. So yes. Palantir is now currently going at 12.4. So it actually sort of justifies the current valuation based on our growth estimates. So it's actually going on discount. So it's 7% discount. So you can actually consider buying it. So, and then what we expect, I think this is something that we never discussed early on. So what we expect the stock price value to be 10 years from now is we can actually calculate that from the 71 billion value that we have here, right, Ravi?
Yep.
So you just divide that by 2, so you will get around $35. So that is the right.
Yeah, Roman, this is the free cash flow. You have to bring this back to present day.
This is the free cash flow, and then it's it's actually at the end of 10 years we expect to have a free cash flow of 3.5 billion on the 10th year, and then assume that I sell my business at 20 times the free cash flow, so it's 71 billion. So what is the expected share price on the 10th year?
Oh, okay, sorry. Yeah, I get what you're saying. So in that case, you just get rid of this. Yeah, and you're just basically adding up this. Cash on hand is 2 billion. Debt is the same. Equity is $9. Value per share is 4.5. I think that doesn't sound right.
No. So I mean, what I'm trying to say is you just put that number back, right?
Okay.
Yes, yeah. So now the 71 billion is the value at which you sell your
the terminal
stock.
value. Yeah.
Yeah. So you just put do the calculation outside of this one. So you have 71 billion by 2 billion shares outstanding. So it's actually $35 equal to, just put equal to it.
Sorry. Okay.
Yeah. So it's expected to grow at 3x your money in 10 years.
Yeah, and this is making the assumption that the shares outstanding don't grow, but for a company like Palantir, they just keep heavily diluting.
So we expect them to do a share buyback. Yeah.
Yep, it's an interesting thought experiment.
Yeah. So we just play with the growth rate, just to give some hope. Yeah.
So let's assume like 30%.
30, 25. Yeah.
25. Yeah.
Because what technically what's expected of a business is once they keep operating for a period of time, they should manage to bring their operating expenses down, over a period of time.
Yeah.
So and then at least you keep the revenue growing at certain percent. So eventually your free cash flow should keep increasing. So that's why you just want to play with the numbers a bit.
Yeah, sure. So if you punch in 30% for the first 5 years and 25% growth for years 6 to 10, you get about $18 a share as the fair value at this moment, which means it's roughly 31% undervalued. That's what.
So we bought at $29. So we were so stupid, at least me. I bought the stock, without doing any of this discounted cash flow at $29.
Yeah, that's okay. It's a long-term hold for you, so it should still be good. And just want to point out that there's not investment advice. We just want to educate our viewers. And I'll leave a link. Ruben, I'm going to leave a link to this sheet in the video description, so people can just build their own sheet and play around with numbers. Yeah. Anything else to add?
Yeah, I think that's all. Yeah.
All right, guys. I hope you had as much fun as we did. Thank you very much. We'll be back with another episode. See you. Take care. Bye.
Thank you. Bye.